Good morning and welcome to the show. I'm really glad to have you guys here. Now listen, today is Monday, July 30th, 2018, and the first thing we're going to do is we're going to take a look at the silver price. So let's start the charts right here and let's get right to silver, see what silver's doing. Silver this morning is at $15.46. What I see with silver right now is I see they've pushed it down as low as they can. Well, I'm not going to say it's as low as they can push it, but they've got it right down so that they're touching the top end of miner, what it costs the miners to get the stuff out of the ground. So see, not all miners are the same. You got some mines out there that can get silver out of the ground for a bit cheaper prices, and you got some of the mines that it costs them more. They have more costs to get silver out of the ground. And so in order to keep the silver shortage from happening, they cannot take the spot price below the mining cost production price, because it should be obvious that most of the silver is coming to supply the world right now, is coming from mine production. They are sucking it out of the ground as quick as they can suck it out of the ground, and it's all sold, every last bit of it. And so you have silver out there that's been hoarded in times gone by, and people have silver stockpiles. And that supply of silver is rather large on the earth. You're never going to run into a shortage of that, ever. I shouldn't say ever, but very unlikely, because it's probably more than 10 billion ounces. But that silver is not silver that is readily available for sale to the market. The silver that's readily available for sale to the market is the silver that's coming from the mining supply, mostly, and the supplying industry on a continuous basis. I tell you how to look at it, how to understand this. The silver that has been hoarded and people have in their own private collections and everything else is kind of like the money that you have in your bank account. You know? Now, that's one grouping of money, the money you have in your bank account. It's allocated as your savings. Then there's another group of money that you get from your job, your paycheck every week, your income. That's what silver's like. The silver that's been hoarded all these years is like the money that's in the bank. It's not touchable. You leave it there. The money that the silver that is like your income is the silver that's coming from these miners. Which is more important, your savings or your income? Well, your income, of course, because if your income is cut off, your savings wouldn't last any time at all, and you'd be out of money. Well, that's the same way with silver. It's this steady supply of silver that's coming out of the ground, something like 800 million ounces a year or something like that, almost 1 billion ounces a year, that is keeping this whole game running. They cannot drop it below a certain price, or they're going to cut that off, or start to cut that off, and they realize that, and that's why they've been dropping it down to $15, roughly $15.46, and then it bounces, or $15.20 or something like that. They drop it down, $15.10 or whatever, because it's about $14 is the higher mines, the more expensive mines, is costing them about $14, maybe $15 to get it out of the ground. And there's no profit ratio anymore. Those mines will close. They can't afford to even have one silver mine close, hardly, because it's such a tight supply in the world right now for silver. The mines are producing at full speed for everything that they can produce, and it's all being sucked up, and every year there's a little deficit that they're having to make up for. And this is where we're at right now with all this. So if the mines shut off, then there's not going to be a little deficit anymore. There's going to be a huge deficit. The silver that's available above ground, ready for sale, which is what the miners supply the world with, will suddenly be short squeezed. There'll be a squeeze on the 1,000-ounce bars they use in industry, and then there'll be a silver shortage. And you know what happens in a shortage? Prices explode. They don't want that to happen, and that is why they're keeping it up in this range of the 15s, and rather than keep dropping it. Look, if it was just these bankers and they could manipulate the paper price without having to worry about the underlying supply, they would take the price down to zero. They're that greedy, you know. They would keep playing this suppression game. But they make a lot of money off of this suppression game anyway. So let's move on to Bitcoin. What's Bitcoin doing today? Bitcoin is at 8103 today. 8108, I should say. 8108. No, 8111. It's going up right now. So if we go to the macro chart or micro chart, or it's showing that that it's starting to. There was a little spike downward a few minutes ago, and now it's starting to turn upwards a little bit again. But it's been following this line here, just over $8,000 for quite a little while now. Going back to the 30-minute chart, we can see it's ever since it went up to $8,400. It's been kind of following this line here at around 8150 or so there, in that price. There was a little dip down, but then it come right back up again. Bitcoin is awaiting news from the SEC for an ETF, an exchange traded fund, on Bitcoin. And now they turned down the Winklevosses, but I think that the Winklevosses probably aren't in the club. The boys in the club are probably going to approve this thing because they want to make all kinds of money from it. They want to have time to accumulate. I don't think the Winklevosses were giving them quite enough time to accumulate enough, and they wanted a couple more months, you know, before it explodes into an ETF. It's probably what's going to happen. I'm not saying for sure. I don't know for sure, but I got my suspicions. I think it's probably going to become an ETF. So now let's take a look at the cryptocurrency market capitalizations right now. We're seeing quite a few coins in the red. Bitcoin is maintaining a very high dominance of 47.7%. $293 billion market cap on all the coins together. And what we're looking at is some of the top coins. Let's say the top 12. Right now, Monero is probably the best buy at 4.95% down. It's down the most of any. Monero right now is 131 bucks. Now, looking for other good buys. IOTA is a good buy right now at 3.3% down, 98 cents a piece. Litecoin's a pretty good buy at 1.31% down, $82.80. So those are your buys in the coins today. Now let's take a look at the Dow Jones Industrial Average today. What's it doing? We're seeing roughly the Dow Jones Industrial Average. Let me just refresh this page and see exactly what it's doing today. She's up 14 points on the day. She's riding a little bit on the high side of a range she's been in for quite a while now. Oil price has been, well, we're going to check oil price right next, but oil price weighs a lot on this market, but also what weighs a lot on this market is the bond market. The bond market's been staying down, but it's starting to move upwards a little bit now. It's starting to trend upwards. So we might see this rally in the market start to be tapered off by the bond market. Money is starting to the bond market, money will start to flow into the bond market. It'll flow out of equities and into the stock market into the bond market at a certain point when bonds get up high enough. Now the mark on that is 3.25% on the U.S. 10-year. That's where I marked that to happen. And so we're going to take a look at bonds just after we take a look at oil right here. Oil has peaked above $70 again. $70.19. It's up $1.50. It's up 2.18%. So oil has had a good little climb in price just today. Should see an increase at the pumps probably next week of maybe a nickel or something. Price of gas will go up a little bit per gallon. Now let's take a look at bonds and rates. Bonds and rates are up today. We're up across the board on bonds and rates. We're looking at 2.988% on the U.S. 10-year. Now, that's the one I really watch, the U.S. 10-year, because most all debt is priced in the U.S. 10-year. And generally, LIBOR follows the U.S. 10-year. So if the U.S. 10-year starts to go up, generally the LIBOR rate starts to go up. So that's the one I keep my eye on. 2.98% now. Remember, we were running 2.85. We're starting to move up. We're getting close to 3%. The buyers must be letting it move again. We're not getting so many buyers that were coming in. The banks were coming in and buying tremendous amounts of these bonds. I don't think it was the central bank that was buying them. It was the banks buying them. The banks have tremendously deep pockets. They slowed this thing off. What I was expecting a couple months, they've slowed it down. I was expecting these prices to start to move up at least a month ago, and they've slowed it down for that long, these bankers. But now they might be pulling away now. And if they're starting to pull away, we might see these bond yields start to explode again. If we take a closer look at the U.S. 10-year here, let's come in for a closer look at the U.S. 10-year. On the chart, we're going to come in for a closer look yet. We're going to go to the 6-month chart. We see it was higher back in June. It was 3.11%. It looked like it was going up to the 3.25, and then we had this sharp decline on the 29th. It looked like the 29th of June. Or May, 29th of May. The sharp decline all the way down to 2.74%, from all the way up from 3.1. This was buyers. Tremendous amount of buyers came into the market from these banks. And these banks, I'm not going to say they were working in collusion with the Federal Reserve, but yeah, the central bank and the top banks, the big banks, work in collusion. So it's almost like the Federal Reserve buying their own bonds, even though technically they probably weren't. It was the banks that were buying them. It's almost like they were, but they drove the yields down all the way down here to 2.75%. And this took the pressure off the market. But now what we see is, because they're continuing with their quantitative tightening program, the banks are probably in the end going to say, stuff you, to the Federal Reserve. We're not buying all $4.5 trillion worth of your bonds. And these rates are starting to climb back up again. They're back up to 2.98% and climbing. It's not too far a stretch of the imagination to think that they might not break this previous peak of 3.10 and start to head up to the magical point that I said of 3.25. Now, when they hit 3.25, it does not mean we're instantaneously going to have a absolute disaster. But once they hit that point, that target point of 3.25 that I was talking about, then we're ready to have the disaster. It's cued and ready. It's like the bullet loaded into the chamber. It's ready to go then at that point. All you have to do is pull the trigger at that point, once we get to 3.25. And so we're on our way, boys, again. We're starting to move up toward that mark. We got bonds on the move again. They're starting to go. Now let's take a look at the U.S. dollar index today. 94.41. And we're seeing she's down just a little bit, 0.25%. No, 0.25 she's down. She's down 0.26%. Excuse me. Now let's take a look here at Japanese bonds. Are in the news right now a little bit. The Japanese bonds, you know, this is a joke. This is a joke. Japanese, now their central market is buying them all. They're completely 100% monetizing their debt, you know. And they're doing this to keep the bond rates low. And the bond rates are trying to creep up anyway, and they're like, we'll buy them all, we'll buy more than all of them. Uh, you know, the whole thing. They own the whole bond market, the Japanese government, and so they're buying it all in order to keep rates down because they can't let rates go up. And believe it or not, they're only given for 10 years. They'll hold your money for 10 years. I mean, who's going to buy this crap? They will hold your money for 10 years, and guess what percentage of interest you're going to get? You're going to get 0.010 in percent interest. You're going to get, was it 1/10 of 1% per year? So over that 10-year period, what are you going to get? 1% over the whole 10-year period for their bonds? And that's to hold money in a corporation, which is Japan, which is defunct, which is completely in debt to the point where they're up to their ears in debt. They're totally, if they were a company, they would have to go into receivership. I mean, so this whole thing is just absolutely ridiculous. They're monetizing their own debt at this point, 100% monetizing their own debt. Japan is a situation that just absolutely could explode in the world markets, and it's been that way for a long time now, but they've been holding it off, and they're holding it off even now by buying everything. The central bank's buying everything, just 100% monetization. So listen, thank you guys for listening. Like and subscribe, and we'll catch you in the next market report coming right up. Bye-bye.